break down the numbers a little bit further here. Joining us now to discuss in more detail, we've got Joe Brusuelas, RSM chief economist, Colin Martin, Schwab Center for Financial Research fixed income strategist, and Claudia Sahm, New Century Advisors chief economist. Guys, I've just now opened up the components to try to go through and see where we saw some increases. I'm sure you guys are all doing the same in real time. Joe, I'm going to go to you first. I see you looking. I can tell you're looking at the numbers here. I'm curious what stands out to you in your sort of first blush reaction.
All right, so we're coming in a bit hot in the service sector. That's really what's driving the data. That's what drove the 0.4% top line growth. I mean, I'm looking directly at this right now. Even shelter came in a bit hot. So what we're seeing here is that, yes, you're going to get your rate cut out there in trading land. But I got to tell you, the underlying tenor of the data here doesn't suggest that it's a lock that you're going to get 3 rate cuts before the end of the year. If you're a hawk on the committee and you're looking at this, okay, you'll sign off on the rate cut next week, primarily due to the signaling at the Fed and market expectations. But the deeper you dig here, it doesn't look so good. It looks to me like service sector inflation is not just sticky, but it's going to be stubborn. And the Fed's got a lot of heavy lifting to do in front of it to get back to 2%. Anytime over the next couple of years.
And Claudia, I want to go to you on this because I find a little irony in this current inflation trajectory, because we were all waiting for the tariff feed through. And yet the sticky components that we're talking about, at least on the face of it, don't seem to have to do with tariffs. They rather seem to have to do with relatively strong consumer demand. Is that the right way to read it?
Well, I certainly would point to some of the service sectors, which we don't think of as being as tariff impacted as, say, the goods areas. But it also gives a good context. We went into this year with inflation still elevated, and that elevation was coming from these service categories. And we've just made really slow progress on moving them back to pre-pandemic, in line with target kind of pace. And that's just, that's been a theme, not just of this year, but also of last year, frankly. So it's really more the context of where we came into this, as opposed to, I think, some, special new feature, like, we've been thinking a lot about how tariffs are affecting right now.
So I guess, Claudia, I would follow up and ask, what is the market is taking as a certainty that the Fed's going to cut. Are there risks in the Fed cutting into this inflationary environment?
There absolutely are risks, and we heard that from Chair Powell at Jackson Hole. The Fed is moving into an easing cycle, and I fully expect them to cut by 25 basis points next week. But it is an easing cycle where they are balancing the fact that there are upside risks to inflation, and that might, as Joe said, get them to pause. Like, this might not be a consecutive set of cuts, and then they have these downside risks to employment. So it's the worst kind of setup for the Fed, because the two sides of their mandate are in conflict in terms of what should you do with interest rates to address them. And today's report, the CPI, it's still too firm, right? Like, this is not consistent with making progress towards 2%. So when they cut next week, they will not be cutting because we have good news on inflation. They'll be cutting because we have bad news on employment.
And speaking of bad news on employment, by the way, I just want to flag another economic release that we just got in the past few moments. That's weekly jobless claims. We don't necessarily always pay as much attention to them, but we saw that jobless claims number at 263,000 last week. That's the highest since 2021. So in keeping with some of the other numbers that we've been getting. Colin, let's bring you into this. We've been talking about what the Fed may do the rest of the year based on these numbers, based on the jobs numbers, and we've been talking about the market expectations. Do you think, the market's probably not going to be disappointed next week, but then what? What are we seeing in terms of what's being priced in?
Well, I'm in full agreement with Joe and Claudia, so maybe it doesn't make for the best programming, but I share the same concerns in that the Fed's mandates are in tension right now, and I don't think we want to get away from that fact. We fully expect a rate cut in September, and as we look to the end of this year, at least one more. We say at least one more because we're expecting two, and then we'll see how the data plays out. Looking ahead, though, the Fed funds futures market is expecting and projecting a sub 3% rate by the end of next year. And we find it difficult to get on board with that, just given where inflation is right now. I want to piggyback on what Claudia was talking about. Inflation is still elevated. It's been elevated, and it's moving in the wrong direction right now. And if we go to comments from Fed Chair Powell about how they want to approach that sort of situation and judge, based on which of their mandates might be farther away from their goal, even though we're seeing a weakening in the labor market, a 4.3% unemployment rate isn't too far from what they expect over the longer run. But 3% inflation is well above their 2% inflation goal. So I think they will ease gradually. But we're only looking at 2 this year, and then we'll have to see how the rest of the data plays out. If inflation does come down, which there doesn't appear to be too much evidence that it will anytime soon, if it does, that will likely open the door for that consistent path lower. Until we see that data, though, we're a little bit more cautious.
Something else I'm struck by in the data is that we continue to be left with this economic background that is not a good setup for lower income Americans. For example, the food at home price index up 0.6%, right? The shelter index, as we've been talking about, which goes into services, up 0.4%. So, Joe, that seems to be not a good backdrop. On the other hand, with stocks continuing to reach record highs, the wealth effect is alive and well. So do we continue to get that bifurcation, and what are the effects of that?
Well, those are the perils of the American K-shaped economy, aren't they? It's very difficult to make policy judgments based on that big economic inequality. Guys, as I look at the data here, I got to tell you, the pre-market consensus that this was all going to be all about services, well, it's partially true. But when I see apparel prices jump by 0.5%, those are tariffs. When I see food prices jump, given the composition of the North American food supply chain, that's tariffs. Moreover, when you see demand for discretionary services jump, we saw a 5.9% increase in airfare prices. That's not really where you want to be just before you're going to start a rate cutting cycle. I got to tell you, I run 4 models, formal models that look at in order to estimate the optimal policy rate. Not a one of them are signaling rate cut right now. I firmly believe we're getting one, but we're really going to be cutting rates into rising inflation here, guys. And this is not exactly where one wants to be. And then finally, Julie, down market Americans are the ones who are going to be shouldering the burden of adjustment. And that's one of the reasons why public sentiment just remains so sour. Just look at those food prices. After we get off, I'm really going to do a deep dive into food prices and see where they're located. And my sense is, you're going to see tariffs written all over that.
Well, let's talk about the vibes a little bit. We haven't talked about this in a little while. We talked about it a lot last year, where we were talking about this sort of vibe session, where people were unhappy, even though the economic numbers looked relatively good. Claudia, what are we like in terms of sentiment versus reality right now? How should we be thinking about that, especially given that last year we saw those big downward revisions in jobs? So I don't know if the vibes were correct at that point then, if that's the way to read it.
Yeah, we've seen over the course of this year some real movements in consumer sentiment. Like in the spring, things really hit the floor and there was a lot of pessimism, and we've seen some improvement. But I will say recently, I think the thing that stuck out to me in some of the household surveys is being a lot more downbeat about the jobs market. Right. And it's important to put all these pieces of data together. We look at inflation, it is still running higher than it had been before the pandemic. You can make up for a lot of that in terms of just, making ends meet as long as the labor market is really working and wages are growing quickly. But we've seen wage growth slow down and, job prospects are not good. So like that, you can come at it, and then that's a piece of the sentiment as well. So I think we're still not in a particularly good place, but looking at a lot of the measures that we look at in sentiment, it also doesn't look like a falling off a cliff, like the kinds of what we see going into a recession. This has been kind of a slog.
It does, yes, it does. It's felt like a slog, that's for sure. Let's bring it back to the markets a little bit more, Colin, with you, and the sort of range where we have seen the 10-year, for example. We've been seeing it sort of start to move below that range recently. What do you expect both into and beyond the Fed cut?
Yeah, we're not convinced that long-term yields, like the 10-year yield, will fall much further, even in the face of the expected rate cuts that should come next week and later this year, mainly due to the inflation that we've all discussed. You know, inflation's still high, and if it's expected to stay elevated, I think there could be that risk premium embedded in that 10-year yield, that investors want to keep it elevated to compensate for those potential upside risks. We're also worried about fiscal concerns. And whenever I bring that up, I always want to highlight that, you know, we've looked at it over the past, number of decades, and we haven't really found much of a relationship between budget deficits and debt outstanding, debt relative to GDP, and what that means to treasury yields. But we worry that at some point a relationship could form, given that the trajectory, continues to be up. And at some point, you might need to see yields stay elevated, maybe increase a little bit to attract that marginal buyer, especially when we're in an environment where, global bond yields have drifted up a little bit, making them a little bit more attractive for investors across the globe. So, kind of summing that up, we don't think that 10-year treasury yields will necessarily fall sharply from here, absent a recession. If we do see a significant slowdown in economic growth or even a recession, we'd probably see the 10-year fall maybe to that 3.5% or lower level. Absent that, we think it might kind of stay range bound and maybe even drift a little bit higher, given those inflationary and budget concerns.
And that's really interesting, Colin, that you bring that up, because maybe not obviously, but can we extrapolate what you're saying about the 10-year to the 30-year as well? And then sort of what are the implications for all of those people out there who are waiting for mortgage rates to come down?
Yeah, unfortunately, we don't expect mortgage rates to come down much further, and that's something we hear a lot. And we talk about with our clients at Schwab that the Fed doesn't control mortgage rates. Long-term yields, 10, 30-year treasuries are more influenced by inflation expectations, the growth outlook, and long-term Fed expectations. And given what I just said, we're not expecting long-term yields to fall much further, and therefore we're not expecting mortgage rates to fall much further, which unfortunately won't provide that relief that I think a lot of people are hoping for the housing market.
Guys, something that we have talked about previously, but we haven't talked about yet today, is the independence of the Fed and that ongoing issue, right? We've had some developments since we've last caught up in terms of the attempt to fire Lisa Cook, her fight back, the presumed confirmation of Stephen Miron and his participation in the Fed meeting next week. Joe, what's your current thinking around these issues and kind of how that could, listen, we know the Fed's independent, but we know they're human beings. And there's a lot going on around all of this. And you're going to have potentially in that meeting room someone who's being attacked by the administration facing off against someone who is a representative of the administration. How should we be thinking about those dynamics?
Well, I think that the Fed's independence has been eroded. And I think that we just need to call it as it is. It's one of the reasons why you see that yield curve steepening. We think it's a bear steepener where the front end of the curve continues to fall, but you see yields rise at the long end. As we move into that, investors are going to be looking at action between the 5 and the 10-year and the 10-year and the 30. The only takeaway that I get from that is that investors are beginning to take seriously the attacks on the Fed. It looks like the Fed is moving away from its official 2% target. When you talk to market players, people who've got real money on the table, they're telling us that, they think the effective target's around 3% now. That's a very big change.
Do you think, Claudia, that once there is a new Fed chair that they would make that change official?
So I would disagree that the target has changed to 3%. I think again they're balancing off risks of higher inflation and lower employment. So but it is absolutely the case that if you look at inflation over the last couple of years, it's settling in much more close to 3% than 2%. So point well taken in terms of outcomes. I don't think that's where the Fed is going. My biggest concern is the outcome of Lisa Cook's case. And I think we really could get some information before this next meeting if she's allowed to stay on and, as her case proceeds as a governor, if, the judicial system really pushes back and is like, no, for cause means something, this isn't just at will, then, that's going to be really important in terms of making sure that you have a Federal Open Market Committee that has some buffer from like short-term politics. And that's something that really hasn't been in question for a very long time. So there may have been some erosion of the Fed's independence. There's certainly been a lot of political pressure, but we are nowhere near the bottom of where this could go in terms of really losing control of monetary policy.
Julie, can I just break in one more time here?
Yes, briefly.
Look, I think that I'm really interested to hear what Claudia has to say on this, because I think that, does the Fed have the credibility to cut into even a one-time increase in the price level? Is their credibility so entrenched that they can do that? And I'm wondering about that right now, because when you see the erosion of their independence, right? Everything rides on inflation expectations and the Fed's credibility. And if it's going to be further eroded, that's just setting the stage for persistent inflation. And I'm having a hard time moving away from that. And I understand exactly what Claudia is saying about the Fed's not going to change their official target anytime soon. But if the market thinks the effective target is 3%, that's what's just as important.